Good afternoon, everybody. I'm so happy to be here and to moderate this very important panel with this very esteemed group. We are not where everyone is in the picture, it seems, a little bit. We're a little messed up, so I'm going to let our panel introduce themselves very quickly, say where you're from so everybody knows who it is. So, Brock, do you want to start?
Absolutely. Brock Arnason, founder and CEO of Droit.
Hi, I'm Lauren Fulks. I am the Director of Regulatory Affairs and Policy at Chainalysis.
Yep. Peter Phelan, Vice President for Strategic Advisory at Elliptic.
And Richard Gabbert, Chief of Staff of the Crypto Task Force, Senior Advisor to the Chairman. And if, Anne-Marie, you'll let me do this, I'll get my disclaimer out of the way, which are that the views I express today are my own and don't necessarily reflect the views of the Commission, the Commissioners, or my colleagues at the Commission.
Great. I remember having to say that when I was at the SEC. And we will not judge, and we will try not to put you on the spot while we're having this. But I might a little bit. Well, the U.S. capital markets are the envy of the world and the gold standard. This stems from our ability to foster innovation and to do thorough and very transparent regulation. As we integrate digital assets into our capital market system, I want to talk about the core balancing act that we have to do between these two. As leaders in this space, how do you all view the fundamental tension between driving innovation and growth and in the digital asset space and maintaining robust compliance? And what are the opportunities for alignment, and are there conflicts with this? Let's start, Brock, let's start with you.
Thank you. So I would say that there are three major participants, and there's a little bit of tension that comes from having slightly different perspectives. So if you look at what you would call traditional financial market participants, the banks, they're coming at this from a perspective of being, in some sense, gatekeepers and responsible owners of the application of certain policy and regulation, right? The act of them being regulated entities in the market means they participate and they are responsible for enforcing certain types of controls, things like AML, KYC, but there are many different other types of controls that they bear. I think that they understand at a deep level that regulation is a form of infrastructure, and in fact, it drives market structure. Then you have the neo-institutions, right? So digital asset native firms who come into this, and they definitely are looking for access to liquidity, and they're looking for access to institutional and retail liquidity. They want access to deep financial markets. They, I think, struggle a little bit to understand that replacing a bank, in some sense, means becoming a bank. In the very literal, if you're a regulated entity, you too have to become the embodiment of these kinds of rules and controls. And so they see regulation as a bit of a brake rather than something that enables the infrastructure that everyone lives in. And then the regulators have, I think, a very understandable perspective where they want to mitigate risk, new types of risk, and they also want to look at the sort of tensions that they normally face, or they're looking to have deep, liquid, safe markets, right, with transparency, but at the same time, they want to be able to look into what the order flow is and understand what's happening. So all of these different participants, I think, have things that they can learn from each other. The tension is, how do you enable regulatory progress at the same time as you actually have technological progress so that you can satisfy those core regulatory objectives, that the banks can learn efficiency and new technologies from the new participants. The new participants can learn a kind of regulatory compliance culture from the banks, and then the regulators can understand the pragmatism of setting a path that balances the two.
That's very good insight. Lauren, what about you?
Yeah, I actually think it's a little bit of a different struggle than we're used to. I don't really see it as regulator versus private industry right now. I think for the first time, as long as I can remember, they're very much on the same page. Everybody wants innovation. Everybody wants to move forward. I actually think where the struggle is a little of an internal struggle at the financial institutions, because everything is moving very, very fast. Everybody wants to do the next best thing. And there's not a ton of incentive right now to have a very regulated or compliance-focused environment. And so I think there's a struggle of knowing that they do need that compliance and regulation framework, but yet everything is moving so fast. So like, and we know it's, you give and you take on each side. So I really do think it's less of the traditional regulator, government versus private industry. I think it really is private industry needs to figure out like what they're gonna do in this environment to make sure that they, I mean, for like future-proof, for lack of a better term, their company. Because this environment is not maybe always gonna be this environment.
Yeah, Peter?
Yeah, yeah. I mean, I look at what's going on today as it's an enormous market structure change that I think can be very challenging for people to figure out how to navigate. You know, in a prior life, I worked on the LIBOR transition, which, if everyone remembers, the reference rate, and we essentially had to peel something out of the financial system. And sort of echoing a little bit of what Lauren was saying, I mean, I think institutions are looking at all of the parts of their existing traditional infrastructure and finding what they need to upgrade. And I think there's like a lot of unknowns out there in terms of what they have to do. And there is, I think, some tension between, you know, like I mentioned, this market structure change. I think the technology is so vastly different from what we're used to in traditional financial markets. I think the crypto native firms kind of started somewhat outside of the regulatory perimeter and were able to do a lot of innovation that way. They also now are like the proverbial dog that has finally caught the car, where, as Brock was saying, they now are becoming regulated institutions. And I think that tension is the traditional institutions figuring out what they don't know about this technology and what they need to incorporate. The crypto native, for lack of a better term, firms figuring out what they need to do to be a best-in-class regulated institution. And then, of course, the regulators, I think, are also learning throughout this whole process how they want to oversee this, what good regulatory oversight will look like. So I think it's a lot of, I mean, there is so much happening, and I think it's a very exciting time to be doing this.
It definitely is. Richard, you and I worked during Dodd-Frank and on some of the rulemakings on that, especially derivatives. What do you, from the SEC's perspective, what do you think?
Well, I actually don't think I have much to add from what my co-panelists have just said. They kind of covered the waterfront. The one thing that I will say is that this is, as I think Lauren said, a really unique time, right? You have two financial market regulators in the city who are eager to work with innovators in this space. It's always easier to innovate outside of the regulatory framework for any number of reasons, right? We at the commission are not, those of us working on crypto are not really allowed to touch the technology. The rules, right? We know our rules well. We love our rules. And sometimes it's difficult for us to get our head around things that don't fall, right, clearly within those rules. And, you know, frankly, you know, the on-chain nature, you know, I don't want to say DeFi because not all of it is DeFi, but the semi-autonomous nature of a lot of this technology also makes us somewhat uncomfortable. We're not quite sure what to do with that. But that is not an excuse now to innovate without keeping your regulator informed. You can come in and talk to us. We're eager to hear from you. We're eager to learn. And so I would, you know, try not to sweep potential regulatory issues under the carpet. I think that may be tempting, right? You know, there's a sense out there that the agencies are less interested in enforcement or focusing on policy making. I would challenge that that's not necessarily the case. Even if it were, it may not be the case in a few years. So engage with us now while, you know, you have folks at the agency who are eager to do so.
That's very interesting, and it actually feeds into my next question for you, Richard. I mean, what you just said is come in and talk to us. There might be a few people in this industry who are a little gun shy about that. But I remember when I was at the SEC, we were actually prohibited from owning cryptocurrencies. Yes. and that led to challenges in understanding the practical working mechanism of the digital asset ecosystem. What knowledge-based challenges does the SEC have, and how can industry help you guys fill in those gaps?
Yeah, so we have a couple of people on my team who, came to the agency after having had the opportunity to, play with this technology in the private sector, including my relatively new chief counsel, Taylor Lindman, who's been fantastic. So they have been really helpful in helping educate the rest of the team and folks throughout the commission, on how the technology works. We've also benefited from people coming in and doing demos, right? We have the technology, you may be astonished to hear this, but to project, your laptop up on a big screen. And so we've been able to see people, using the wallet interface technology, showing us how their data analytics tools work and so on. So there is, if you do have technology and you're not convinced that you're going to be able to explain it on a PowerPoint slide deck, right, to the regulator, consider other possibilities, right? There's all kinds of technology. I will admit that it's not the same as, going myself and degenning in crypto for a couple of years, right? I will never have that experience unless I leave the agency. But it is really helpful for us to get a better sense as to what's going on under the hood, so to speak.
And would you encourage the audience or people watching to actually make those appointments and come in?
Yeah, and we, I think we've had, I've been saying this for a couple of months now, over 200 meetings with members of the public. It's probably north of 250 at this point. And on the SEC website, there is a link to the Crypto Task Force section of that website. On that page, there is a button you can press to request a meeting with the task force, and that'll give you a form to fill out. The agenda will eventually, after the meeting has occurred, be posted to the website so that the public at large can, get an insight into what conversations the task force is having with the public.
That's great, and that's very helpful. I wish we would have had that when I was at the SEC. Yeah. Brock, Lauren, Peter, how are your companies and your insight into the industry at large adopting the rapidly changing compliance landscape? You've got the evolving SEC guidance, global regulatory fragmentation, Genius, Clarity. There are new tools for on-chain monitoring. What are you guys doing to do that? I'm going to start with Peter.
Yeah. I sort of divide it into two worlds, so to speak. I think of Genius, obviously already in statute and the regulations coming out, as really focused more on like the traditional bank market, a digitized dollar. A lot of the conversations that we've been having at Elliptic have been focused on, the traditional payment rails, people looking at stable coins, how they can utilize stable coins, and again, looking to, I know there's some comments that are still open, I guess for another few hours, but how to maintain compliance with existing, Genius Act language, how you can use stable coins for payments in a traditional bank system, how you can think about different structures like tokenized deposits. There's been a lot of discussion, I'm sure people have heard in the news recently, about large banks as well as regional banks looking at various forms of network clearing, sort of akin to like an ACH, and stablecoin reserves that banks can hold. So there's a whole lot of questions about how traditional institutions can integrate the information that we provide at Elliptic on the analytics, the wallet attribution, how they can start integrating that into their traditional BSA AML programs. Then the second part of it I call more like clarity focused, which would be more in Richard's wheelhouse and the CFTC, the other markets regulator, in terms of tokenized RWA. And again, appreciating clarity is not done, but there's been some discussions. And then that gets into things like traditional capital markets instruments, right? Tokenized equities, tokenized treasury securities. I think in one of the earlier panels we talked about New York Stock Exchange is partnering up with firms like Securities, DTCC, starting to do some test cases for tokenized treasuries. So all of that is really like people just trying to figure out, number one, the technology, and then how they can integrate it into their existing kind of enterprise risk frameworks, risk management. And so that's kind of the way I look at the two sides of it.
Okay, Lauren, what about you?
Yeah, so I think for us at Chainalysis, it's more of kind of taking a look at our solutioning as it has traditionally been. We've been around for 10 years, so we have somewhat deep roots in like the intel and law enforcement community. A lot of our tooling has been used to trace through the blockchain. But with everything going on, we have been having to look at, well, how is our solutioning going to help regulators and market regulators and kind of like a different use case and a different set of customers. So a lot of it for us has just been keeping up with everything that's going on and then figuring out like with our existing solutioning, how can we repurpose that to meet these like very evolving, very sophisticated needs. And of course, I'm more focused on the regulatory public side than the private side. So again, for us, it's been, okay, it's not just enforcement use case. It is the entire regulatory life cycle. It is policy. It is compliance. It is surveillance. It is everything that encompasses from start to finish. And so we really have been paying a lot of attention to kind of what are the needs and how can we meet them.
That's great. A lot of people think this is round peg, square hole, and they won't actually mess up. But Brock, you guys have been doing this for traditional finance, helping them do compliance since Dodd-Frank. What's your perspective on this? What have you guys been doing, and do you think you can make it work?
Well, so as a quick aside, so that everyone understands what Droit does, we are in the business of providing real-time compliant regulatory decisions for financial institutions. And our clientele consists of who you would expect, all of the biggest banks in the world, and sort of tier 1, tier 2s, large asset managers, hedge funds, and in fact, some crypto firms. And what do we do for them? We encode the law. So we take the law, we allow people to treat it as data, and to tap into a consensus implementation of what that law is and what it means to be subject to those rules. So you're right, we started with Dodd-Frank, did MiFID, MiFIR, EMIR, global reporting obligations, many different types of decisions. And for us, TradFi institutions, right, the big banks, they are finally seeing an entry point to being allowed to participate in this marketplace. So for them, who are our existing clientele, it's a very natural extension to say, okay, well, I'm generating these proofs of compliance on a per transaction basis in real time for all of my normal capital markets activity. Why would I not do that for these types of products? And in fact, some of the same rules apply, right? The reason why we have some digital asset native firms is because they trade swaps that have to be reported, right? They have some of those same obligations. But there are new rules, of course, and those new rules will be applied in different ways. But the whole rationale behind the way that we do it is we create a trace so that you can take a particular transaction, trace it through to the version of the law, and evidence when you're audited, when a regulator wishes to understand what you did, to how you did it. So we see it's a natural extension for those firms. For new market participants, I think it's a really interesting opportunity to build the compliance capabilities of a bank without sort of inheriting the legacy cost and huge people-based structure. Because if you can do it consistently from the ground up with new technology, you have really interesting opportunities. Most of our existing clients, they create these proofs, these audit records, and they store them on-prem, right? The blockchain creates a really interesting opportunity. Why don't you take that proof and hash that proof on-chain? And now suddenly you can actually sort of exchange evidence of compliance for certain rules from participant to participant, and that creates new and interesting opportunities.
Okay, great. Well, I think we've all been listening and talking about clarity. It's something, if you're in Washington, D.C., it's all you talk about. We are all looking forward to having that legislative clarity, the ability for the regulators to write rules with clarity, and hoping the Clarity Act passes this year. But I'm going to say, in a worst case scenario, I might be committing blasphemy in the crypto digital ecosystem by asking this question, but in the worst case scenario where clarity does not pass, how do we move forward? And Richard, I'm going to start with you on the regulation side. How would the SEC move forward? Have you guys thought about that?
So, I mean, we're also very eager to see clarity pass. I think there is a lot in that bill that is very good for the markets. It will help resolve potential gaps between the SEC and the CFTC, ensuring that investor protection and market structure concerns are addressed kind of pretty much across the entire waterfront. So, you know, we're looking forward to that. We're optimistic. In the event that it doesn't happen, I mean, I think that what the commission, well, the two commissions jointly did in March with the interpretive statement that kind of provided a taxonomy, it kind of leaves us in a space where the commission is really, and when I say commission, I mean the SEC, is really going to be focused on securities, tokenized securities, stablecoins to the extent that they're used by our registered entities, and then tokens that are issued as part of a fundraise or an offering, right? And thus subject to an investment contract. And you know, with respect to tokenized securities and then stablecoins, which we don't have implementing authority over, but we do need to incorporate into our registered entities operations to the extent that they're going to move on chain, I do think we have a lot of the authority we need to do to address those. As Commissioner Peirce said last summer, tokenized securities are securities, right? And so between, you know, rule text, which in many cases can be adapted to various forms of technology, and the exemptive authority that we already have, I think that there's a way for us to, you know, accommodate a lot of this activity in our regulated space. That said, and, you know, if clarity is there, we would have all the authority that we need. It would be unquestioned, but we'll see what happens on the Hill.
Lauren, what about you?
Yeah, so I have a few different views on this, and I didn't say it at the beginning, but I actually was at the CFTC the vast majority of my career. I just got to Chainalysis in January. I was at the CFTC 17 years. So I still very much look at things through CFTC lens. But before I get to that, I will answer kind of through my Chainalysis lens. So if clarity does not pass, there's going to be a focus on the states. So New York, California, right, they have their own regimes, and they're going to take off, and they're going to have to do a lot more than they've been doing or do what they have planned to do without clarity. And then you also see other states that maybe don't have those full regulatory regimes, but they have money transmission laws, and you're seeing those starting to get implemented. So we're, as a company, will shift a little bit away from federal to state. I mean, we are doing a lot of state work now, I will be totally honest. But you're really going to see that shift, I think, which, again, and this is kind of my pre-CFTC life. I was in enforcement. I did a lot of things, but I was in enforcement as an investigator for a good chunk of time. And I just cannot imagine a world where we do not have a market structure bill. It's so inhibiting to not have a prudential market regulator. And it unfortunately does lead to, regulation by enforcement, because that's your only tool in the toolbox. I don't think any of us, and on the regulator side, I guess I'll speak for myself, like nobody was like out to get crypto. It was just like enforcement was our only mechanism. And so for me, like I hope that clarity really passes so that there are more tools in the toolbox. But kind of as Richard was saying, there's still a lot of activity that can be captured between the SEC and the CFTC. He spoke to the SEC, but for CFTC, perps, perpetual futures. I mean, that is a huge volume of business, and derivatives right now fall under CFTC jurisdiction. There's no question. So all of that activity, falls under the CFTC with or without clarity. So I think, yeah, I mean, like I said, I have multiple views on it. I really hope it passes, because I think it's just going to make things so much more complicated if it doesn't.
Peter?
Yeah, no, I mean, agree. I would like to see that passed. I loathe the fact that this thing is called the Clarity Act because we keep saying it'll give us greater clarity. Maybe that's obviously the purpose. But look, there are, like, without having clear legal frameworks, there can always be challenges at the regulators. I think there's a ton of authority, as Richard mentioned, at the SEC, CFTC. They have a lot of authority over existing markets. The issue is that when you start starting with a novel technology, the creation of novel financial products, you are going to have gaps. The commissions are going to have to look to things like no action letters and various sort of stopgap measures to try to coordinate that in the best they can. And that creates issues. I traded derivatives for a long time. Derivatives were not regulated until, I don't remember. Everyone remembers 2008, Dodd-Frank finally came out as a reaction to an enormous unregulated market. And so I think anytime you do that, you create potential issues. I'm not saying there will be issues if clarity doesn't get done. I also think that, having that legal certainty just gives we're talking about the market regulators, we talk about the prudential regulators, also having that whole of government approach, which you get through, I was at Treasury, Financial Stability Oversight Council, that kind of oversight mechanism where you have a gathering of all of the regulators to look at what authorities do we have. Obviously, clarity would give you a lot more certainty around that. And then just closing in those gaps. So I think it's really important. The industry, I think the digital asset industry has had some issues in the past, certainly reputationally. There's been some issues in years past. I don't think anyone wants to see that. And I think the more we have that legal certainty, the better it is for innovation and for the industry writ large.
Great. Brock?
I am going to take the most optimistic perspective. And I'm going to say that I think there's a huge amount that you can do with a memorandum of understanding, no action relief, and interpretive guidance. And we saw that with Dodd-Frank. I remember the introduction of the MOU between the SEC and the CFTC. Some people here may have worked on that. And that was a very complex document that described what a security-based swap was, a non-security-based swap, and what a mixed swap was. Something that was very high level described in the actual statute, but then the details were quite important. I don't see this as being all that different. And I think that if the SEC and the CFTC wanted to get together and essentially do another version of that, they could.
Great. Well, I'm very happy because hearing you, it's a little different than what you see on crypto Twitter. No one's saying that if this, in the worst case scenario, and we are all crossing our fingers that it doesn't happen, that if it doesn't pass, everyone's going to move off shore and we're going to have a huge exodus and America's going to lose. So I'm glad to hear you guys aren't saying that. Richard, you actually brought up tokenization. And I would be remiss if I didn't ask about the innovation exemption. According to rumors downtown and on Twitter and different things, you guys are going to be naming the innovation exemption maybe on the stage right now. If you want to, it'll be okay. But while we're waiting on that innovation exemption, whenever that may be, I'm not going to put you on the spot to say, give us a time frame, but is there something that that people can go to do regular order? Because one of the questions I've got is, tokenized securities even legal without the innovation exemption? So is there a path forward, and can people be working with the SEC to try to do that?
So I think that is an interesting question. The innovation exemption, as Commissioner Peirce and Chairman Atkins have described it, is really envisioned to be about the trading of tokenized securities, and not any kind of trading, but specifically trading on novel types of trading platforms. Think AMMs, for example. I don't know, and there perhaps are folks outside the building who are thinking about these issues, but it's not clear to me that there's anything in our laws that is preventing somebody from setting up an ATS, for example, to trade tokenized securities today. There is, in my understanding at least, is that there is a significant amount of activity happening in the sec lending and repo space in terms of the exchange of collateral using tokenized securities. Various issuers have tokenized their shares. Whether those tokens are capable of being freely traded, for example, on some kind of platform is a separate question. But as the three policy divisions of the agency said back in January, right, there are various approaches to tokenization. And I think the central message of that joint statement is that if you are going to tokenize, make sure that, surprise, surprise, you follow the law, right? If it's a separate security from the underlying security, then consider your registration and disclosure obligations. So, I do think that there's probably quite a bit that folks could do with respect to tokenized securities without the innovation exemption. And I would be remiss not to mention some of the other actions that the staff or the commission have taken, right? There's the DTC no action letter from last December, which clears the way for a pilot program for DTC to tokenize the securities that it holds on behalf of broker-dealers. There's the approval of NASDAQ's rule filing, right, to permit the trading of tokenized securities on its exchange. And so I think folks should not, let the, status of the innovation exemption affect how they engage with the commission and with their own counsel to determine what may be possible without further action from the commission.
Great. I'm looking at our time, so I want to make sure I ask this question that I usually ask on panels. But what keeps you up at night? So what are the issues, the major issues that you are seeing, especially in regards to making sure we have a balance of growth and compliance in the digital assets? What are you guys thinking of, and what do you see as success 5 years down the road? Is it a mature system, a resilient system? What are you guys saying? Brock, I'll start with you.
Okay. Liquidity fragmentation. So I think that we live in a world where in this space you have offshore and primarily DeFi protocols where there's a huge amount of liquidity that is completely separate and largely isolated from regulated central exchange-driven liquidity. And I think that's a problem, right? So, I mean, I don't think I need to explain why liquidity fragmentation is a problem. People don't get as good execution. But there's a reason for that, and the reason for that is that these protocols generally don't allow for certain types of compliant activity, right? So I think that there are ways of solving that problem. One of those ways is to apply the idea of a kind of prime broker-ish relationship that you see in capital markets, right? In the FX space, you can get a price and not have done all of the documentation due diligence on the person requesting the price because you end up facing, say, Goldman as the prime broker, right? And that prime broker is responsible for having done all of that work. I think these sorts of concepts can help. And in an ideal world, I'll just say two things that I would see in 5 years. I would like to see some sort of a bridging of that liquidity and a way that you could actually have compliant execution in DeFi facilities. And in my fantasy world, maybe some form of substituted compliance.
Okay. Lauren?
Okay, I'll start with the ideal because what I'm going to say next is I'll start with the ideal. Okay, so ideally in 5 years, I think it would be great if it was more of a there was more of a mindset that crypto just isn't used for crime or it's just illicit. That, I mean, we're in it, and so we don't think of it that way, but I think a lot of people still think of it that way. So in 5 years, it would be great if that wasn't the first thing that most people thought of, and they really viewed it as a real financial market or a real means of payment, whatever it evolves into, but just not that it's just used for criminals. I mean, yes, there's a lot of criminal activity, but that's not all it's used for. Okay, what keeps me up at night? Okay, I have no reason to believe this is going to happen, or I will just caveat that right now, and a little bit against what we were just talking about with clarity. But if clarity doesn't pass, there is one piece of clarity that I don't think gets a ton of attention or hasn't lately, because of just all of the other issues swirling around. But one really important thing that Clarity does for exchanges that hold customer funds, it segregates those funds. So in the event that the exchange goes under, your funds are protected. And that feature is something that's very unique to the CFTC regime that will then carry over into the crypto regime. My fear is if Clarity doesn't pass and something like that doesn't get implemented, that we're going to see a big exchange have an issue and customer funds be lost and there be no mechanism or no repercussion for that.
Okay. Peter?
You know, what I worry about today is I think we're at a really good state in terms of like market starting to utilize the technology. I do always worry about, certainly like conversations I have at Elliptic with people across the industry, is people embarking on the utilization of these new products, the new technologies, and not really fully understanding what they're doing. I think that's a critical piece. And, you know, I do worry about I hate picking on smaller institutions, but a smaller institution with less capital budget, less sort of people working and looking at, you know, really signing on to something that they don't quite understand and then having, you know, a real issue with illicit finance use or other kind of use cases that we see. Obviously, we see in traditional finance as well, and so that's the thing I worry about the most. In terms of ideal state, I think, you know, 5 years from now, if we do things right, it's a big market structure change. If we all focus on it, you know, Richard is going to get his clarity into what he can do, and they do great rule makings, and we're going to get through all of that. And we have a financial system which in the US is already the most robust financial system in the world, is better, is more efficient, is more, you know, capital efficient, and that it accrues to the benefit of Americans in general, which is what we all want.
Richard, what about you?
Yeah, I think one of the things that keeps me up at night is, you know, it's been really interesting watching the pace of innovation in this space against great odds as well, with respect to various crypto assets and the underlying technologies. Now that, you know, the commission has provided this taxonomy, I think it's now clear, right, that the agency is going to be focused on securities. And when folks are experimenting in whether it's the trading or distribution or whatever of securities, I think that can be a very good thing. But there's a much bigger picture, right? We've got a huge financial market with you know, thousands of issuers and livelihoods hanging on what happens in those financial markets. And I am not asking folks to delay or slow down innovation, but make sure now that you know, if you know you're dealing with securities and you're in the SEC space, do come in and engage with us, right? Again, I reiterate the point I made at the very beginning. We are willing to have these conversations. Don't assume because you're on chain that the laws don't apply to you. So that is one of the things, is that folks will get that balance between innovation and actually going in and checking in with the regulator wrong, to their own detriment later and to the market's broader detriment. 5 years from now, I hope that we'll have clarity in place. We will have made it some way down that marathon of rulemaking that we have. Anne-Marie, you and I know what that looks like well from our experience with Title VII. It's doable, and we have the folks at the Commission who are ready and eager to get that rulemaking started. And I also hope that we have an agency that is more nimble in accommodating innovation, is able to understand new technologies better and recognize when it's important to say, no, we can't permit that because the risks are too high, as opposed, and also be willing to acknowledge that there can be real gains from new types of technology in our markets.
And do regulators have any concerns about innovation and the industry's development outpacing the oversight, the government's ability to do oversight?
Yeah, I mean, this is an open question, right? There's a whole avenue that we could pursue here. So, for example, to take the example, somebody earlier mentioned the possibility of using the blockchain for books and records and that sort of thing. And I personally am eager to see the technology put to these new uses, but I think that there are a lot of questions that we need to answer, right? And so, figuring out what it means, for example, for electronic records to be reasonably available, right, or reasonably usable in the language of 17A3 and A4 in the context of a blockchain, right? That's an important question to answer, whether the blockchain will persist long enough to fulfill the record-keeping requirements of regulated financial agencies and so on. So that's just one example. There are questions about surveillance as well, whether we have the appropriate tools, whether other SROs have the appropriate tools. But these are areas where I think continued collaboration between the regulators and folks like those here on the panel today is going to be important.
Perfect. Well, thank you guys all for joining us today, and this was a great conversation, and look forward to whatever comes next. Thanks, guys.